All right. Welcome back to Lecture 3 for Accounting 330, Introduction to Income Taxation. I think I'm starting to get the hang of this. I wasn't really happy with the way the audio was in the last video either, so I'm still recording from the same microphone, but I've jerry-rigged the setup here, so I no longer have to have the headphones draped around my neck. I think audio is going to be a work in progress as we go on through the semester, but hopefully this time, hopefully we got it. So last two lectures we talked about Chapter 1, the basics of tax terminology, some basic types of taxes. We talked about taxes at the local level, at the state level, at the federal level. This time we're getting into Chapter 2. And we're going to start off by talking about tax policy, and then we're going to talk about the specific characteristics of a tax, right? You could have a tax that is a good tax and a tax that is a bad tax. We're going to talk about what makes a good tax a good tax. Let's start out by talking about tax policy. What is tax policy? Well, tax policy is a government's attitude, objectives, and actions with respect to its tax system. And when we talk about tax policy, obviously all levels of jurisdiction could have their own tax policies that have similar goals, or they could each have their own tax policies that have very differing goals. So, federal, state, and local jurisdictions could have their own tax policies. And like I said, these could have overlapping goals, or in some instances, different jurisdictions could have different goals when it comes to, their tax systems. I mean, just think about the differences we saw in, for instance, the presence of a personal income tax when we talked about a state like Texas in comparison to a state like Kansas or California or whatever. Or just think about the certain states that didn't have some sort of a sales tax, right? So each state's tax policy differs. Different jurisdictions can have different views towards tax policies. And the views of the jurisdictions will all influence the type of taxes that they have in place, as well as, the base of the tax, the rate of the tax. So all aspects of the tax will be influenced by that jurisdiction's tax policy. So starting off the lecture, this session, I talked about, good taxes and bad taxes. Well, there are certain characteristics that a good tax should have. A good tax should be, first of all, sufficient. A good tax should be convenient. A good tax should be efficient. And a good tax should be fair. So as many of these characteristics as you can put into the tax that you're planning out, or your tax policy, holistically incorporating as many of these characteristics as possible, will lead you to have good taxes, right? So today we're going to talk about sufficiency and convenience, and in the next session we'll talk about efficiency and fairness. But let's give a brief definition of what all of these mean. So sufficient, as the name implies, the tax must raise the required governmental revenues. So as we saw last lecture when we looked at that pie chart that showed us where the anticipated federal budget was coming from, a large portion of that pie chart was coming from taxes. So taxes should be sufficient to raise enough revenue in order to meet the expenses that our jurisdiction, our tax body, our government level is going to have. A tax should be convenient. It should be easy to administer and easy to pay. So convenience has two aspects, right? From the government side, it should be easy for the government to administer. And from the taxpayer's side, it should be easy for the taxpayer to pay. So if you think back to the past two lectures, we talked about certain taxes that were not very convenient, and we'll circle back around and talk about those here in this chapter as well. Efficient, I'm just talking about in economic terms. The tax should be efficient, and this has to do with the concept of deadweight loss, which if you've taken an introductory economics class, microeconomics, you've heard about this concept of deadweight loss, and we're going to talk about that more in detail next video. So efficiency has to do with economics of the tax. Is there too much deadweight loss being created? And fairness is just as the name implies, it should be fair. Right? Your tax shouldn't put undue burden on one part of the population and not on the other part of the population, right? I mean, the burden should be shared equally, fairly. So a good tax should have all of these characteristics embedded in it. So first characteristic of a good tax is sufficiency. And what did we say sufficiency was? The tax should raise enough revenue to offset the expenses of the government, whether it's the federal government or the state government or the city government, what have you, right? And this little shape, this little figure illustrates it, right? Our expenditures and our revenues should have a fine balance if we're talking about sufficiency. Now, here is a question. Is the federal tax system sufficient, right? What does sufficiency mean? Well, I mean, this is the third time that we're really talking about this over the past, 8 minutes, but a sufficient tax is one that generates enough funds to pay for the goods and services provided by government, right? If the tax system is insufficient, then the government needs to make up revenue by other means, right? So sufficiency is defined like this, right? It needs to fund the goods and services provided by the government. Now, the government's function is to provide goods and services for its citizens, right? That is the only function of the government. And this goods and services are, like roads, schools. If you're talking about the federal government, the military defense is a service, right? And regardless of your political view, everybody believes that the government should provide a certain level of services, right? Whether it should provide more or less services kind of depends on where you lie on the political spectrum, but we all believe that the government should provide some level of service to its citizens. And in order to offset the costs of providing these services, the government needs to levy taxes, right? Because if the taxes are not able to raise enough revenue, then the government needs to resort to other methods of offsetting these costs. For instance, borrowing, right? The government borrows the debt. We have this concept of governmental debt that increases. But just as a quick, thought piece, this is the proposed budget for fiscal year 2021. Right? We already saw this piece of the pie. Right? We saw that in the pie chart. We saw where that $6,860,000,000,000 was, proposed to come from. This is the other side of that coin. This is what we as, a government, a federal government, are proposing to spend in the next year. So, do you think our federal tax system is sufficient? Well, obviously it's not, right? Because we're not raising enough revenue here to offset our spending. So we have a $1.015 trillion deficit, right? There's a budget deficit. Now, there's some way in which the government is going to have to raise these funds. So the government is either going to have to borrow money or look at some other avenues of possibly raising these funds, right? So this means that our system is not sufficient. Now, what should we do, right? We could either decrease spending, we could either increase taxes, we could do both to an extent, right? Increase taxes a bit, decrease spending a bit, leave it as it is, or we could do neither. Don't do anything and just run a deficit. Right? These are all options that are at play that, people debate about constantly. So here is a figure that we already saw in the last video, right? This is the proposed revenue split for this upcoming fiscal year for our federal government. This is where our $3,860,000,000,000 is going to come from. And we talked about how, a big chunk of it is from income taxes and payroll taxes, and 50% of it comes from individual income taxes that you or I pay, 7% of it comes from income taxes that corporations pay, and 36% of it comes from the payroll taxes that your employer pays to the government. Those taxes are earmarked for specific purposes, right? Now here is the other side of that coin. This is the proposed spending for the next fiscal year, right? Remember, 2 slides ago we talked about how we were, forecasted to have a deficit. This is the spending that we're doing that is going to potentially lead to that deficit. Now, some of this spending is mandatory, meaning that legally you can't really alter these amounts, right? So the Social Security spending, the Medicaid spending, and the Medicare spending, as well as this other mandatory piece. So this, let's just write some M's on it. This is mandatory. This is mandatory. This is mandatory. And then I believe this piece is mandatory right here. Right? So these are all the mandatory pieces of spending. Makes up about 14 plus 24 is 38, plus 9 is 47, plus 15 is 62. So 62% of the 4.8 trillion that we will be spending in the next fiscal year is mandatory spending. We can't really alter those amounts. So if we were to go and cut some sort of spending, it would have to be from this discretionary side, right? And when we talk about discretionary, the biggest piece is the defense budget. That's what's allocated to the military. Then we have non-defense spending, and we also have interest payments, right? Interest payments we can't really do anything about because that's just payments on the debt that the federal government owns. But if we were to try to cut spending down a bit, right, we're running a $1.1 trillion deficit, it would have to come from either one of these 2 boxes here, right? It would either be discretionary defense spending or discretionary non-defense spending. But just as you can see, we don't have a sufficient tax system at the federal level, right? And if you look at this figure here, you can see that the revenue generating sources for the federal government has significantly changed over time, right? This bottom chunk right here represents individual income taxes. So this is what you and I pay. This chunk represents payroll taxes. This is corporate income taxes. This chunk represents excise taxes. And the top is just other taxes. So as you can see, other taxes and excise taxes as well. So these two categories were never, that relevant. I mean, I guess if you go all the way back to like the 1930s, early 1940s, right around here, excise taxes generated a very large portion of governmental revenue, but it shrank pretty significantly after that, right? And then there's this little chunk of time where corporate taxes generated as much revenue as individual income taxes, but like 1945 onward, a bulk of governmental revenue has been generated by the income taxes that you and I pay, right? And paying taxes is definitely not anybody's favorite activity, but it's a necessity, right? Because the view is that taxation is theft, and I could sympathize with that view because it's, my money going to the government and I don't have any discretion over how it's spent. But, at what point do you say, well, the government needs some of this money, right? Like, how are we going to fund the military? Or how are we going to fund science, right? The more tax money we take away from the government, the harder it is to fund the military, to fund some of the other public services that the government is providing. So if revenues are not covering expenses, the tax system is not sufficient, which is what we have been talking about so far. And if the tax system is not sufficient, how does the federal government pay for spending? Right? Well, there's a few things that the government can do. The government can modify taxes a bit. They can exploit a new tax base. They can increase an existing tax base, or they can change tax rates, which we're all going to talk about in the upcoming slides. But one thing that the government can do is borrow to offset spending, right? And our government has been doing that more and more. As the sufficiency of our federal tax system has decreased, we as a government, a federal government, have ended up borrowing more and more, right? So this graph is showing you total public debt as a percent of gross domestic product. Now, gross domestic product is a key term in economics, GDP. You might have heard of it. It's essentially representative of the total economic strength of a nation. It is, as the name implies, the gross domestic product. It is a summary, an addition of all of the production that we have domestically within the United States. Right? And this generally is just showing you a ratio of public debt to gross domestic product. So as you can see, up until very, very recently, like 1990s, 2000s, even 2010, our debt to GDP ratio was fairly manageable at like around a 60, between a 60 to 70%. So our debt was smaller than the amount that we could produce as a nation within 1 year. But recently, our debt to GDP ratio has skyrocketed, and it's actually surpassed 100%. So now we have more debt than we can produce as a nation in a year. So, there's different views on debt as well, and this will depend on where you lie politically on the spectrum, right? Some people believe that debt is necessary, especially if you're not willing to raise taxes very high And some people believe that debt is, a bad thing regardless of any sort of reasoning. So just as another example, this is a table that I pulled from The Economist magazine, which is why it says China's debt as a percentage of GDP. But, cross out, like, we're not really focused on China here. I just want to show you comparatively where nations are, right? So this is showing every nation's debt as a percentage of GDP. So, a high debt as percentage of GDP ratio doesn't necessarily mean a bad thing, because we have Japan, right, a very strong economy, but they have a very high debt to GDP ratio. US, we said we recently surpassed 100%, so we have a fairly high debt to GDP ratio, right? France, Canada, Germany, UK, these are all strong economies with close to 100% debt to GDP ratios, right? And on the lower end of things, like, I'm going to dog on Turkey because I was born in Turkey, but Turkey doesn't have a strong economy, and it has a low debt to GDP ratio. So a debt to GDP ratio doesn't necessarily indicate the strength of your economy as a country. It's just, an indicator that you're holding on to a lot of debt, that your tax system is not sufficient maybe. This is another graph of, debt to GDP ratio across countries in Europe. And once again, you can see that a lot of strong countries have fairly high debt to GDP ratios, right? Like France, 91%, Germany, 82%. But there's also some very poor economies that have high debt to GDP ratios, like Greece, Italy, Portugal, and Ireland all have, above 110% debt to GDP ratio. And those are all economies that have been struggling in the past. Meanwhile, Estonia, right, is a 7.3%, but it's not an economic powerhouse by any means. So, I guess the takeaway is, if you don't have a sufficient tax system, you need to fund your expenditures in some other way, and debt is the predominant alternative of funding government expenditures if you're not able to meet those expenses with the revenue that you're raising internally through taxation. And I guess the takeaway from this figure specifically is a high debt to GDP ratio is okay unless you let it get away from you, right? Like, if you let it get to 150% like Greece, or 120% like Italy, then it might become problematic, especially if you don't have the strong infrastructure to constantly be able to run that level of debt. Now, we looked at things from federal level. Let's see how we are as a state, right? So the state of Kansas, once again, this is the proposed budget for fiscal year 2021, and as you can see, obviously it's significantly smaller than the federal budget, right? In the federal budget, we were talking about 3.8 trillion incoming revenues versus 4.8 expenses, 4.8 trillion. Here we have 7.8 billion of expenses that are matched by like 7 or 8-ish billion of revenues. But most, as you can see, of our expenses are going to aid K through 12 schools, right? So that is a service that is provided by the government, kindergarten through high school. Another large chunk is aid to universities, right? A lot of the public universities, whether it's KU or, those disgusting people down the road in the purple school, those are all government-funded organizations, funded by the state government. Health and Human Services is another service that is provided by the state government, right? And then we have judiciary, general government services, public safety, agricultural and natural resources, and other expenditures. So out of, the 7.8 billion expenditures that we're forecasting, half of it is going to education, actually more than half of it, because around 63% of it is going to education, 17% is going to health care services, so on and so forth, right? So once again, like, what level of service should the government provide? According to your answer to that question, then you should have a proposed set of expenditures, and then you should have a tax system in place to meet those expenditures, right? These are all contingent on your tax policy. And this is where the state of Kansas is projecting the revenues will come from. Once again, all of it, almost all of it, tax revenues, right? We're generating $7.9 billion of tax revenues in fiscal year 2021. Once again, 51% is individual income taxes. So the largest portion of this is individual income taxes. 6% is corporate income taxes, and another large chunk are sales taxes, remember? It says sales and use tax, but as we talked about last class, it's very hard to enforce a use tax, so most of that is going to be sales tax. There's a small chunk coming from excise taxes, and then there are some various other smaller taxes that are raising revenues for the state of Kansas. Now, the federal government had a tax system that was not sufficient. We had 4.8 trillion expenses versus 3.8 trillion revenues, right? There was a 1 trillion deficit. The state of Kansas, the tax system seems to be sufficient for the time being. We have $7.9 billion of revenue being raised, and we have $7.8 billion of expenses, right? So the tax system in Kansas seems to be sufficient. Well, is it a good system? We still have to look at those other categories as well that define whether a tax system is good or bad. And once again, all of this has to do with the tax policy. Like, what is your goal as a state, as a federal government, as a county? What is your goal with your tax system? What is your tax policy? And that'll shape what kind of taxes you have in place. This is just from 2015. It's showing you where states generate their total governmental revenue. So first of all, as you can see, we were talking about Kansas in 2021 having $8 billion revenue generation. So it's fairly similar here as well. This is where Kansas is. So if you can see, we're around, 8 to 9 to $7 billion even in 2015. But, a state like California has a massive economy. So they're generating, 150 to $160 billion from taxes. Similarly, New York has a much larger economy. They're generating $80 billion-ish from their taxes, right? And as you can see, for almost all states, most of the revenue is coming from income taxes, right? California has a huge chunk of this bar that is red. Similarly, New York has a huge chunk of the bar that is red. Texas, if you remember from last class, doesn't have a state income tax or a corporate income tax. So most of their revenues are coming from sales taxes, right? So as you can see, most revenue is coming from sales taxes and also income taxes for all states. There are some that have licenses and fees that are popping up in green. Some have, other that pops up in blue. But for the most part, we're talking about income taxes and sales and use taxes for state governments. Now, we talked about how the federal government was running a debt, right? Because of the insufficiency of the tax system. Now let's look at how the 50 states rank in terms of their fiscal health, right? So, as you can see, Kansas is in the blue. So we are about average in terms of our fiscal condition. We're ranked 32nd. This is in 2017. The best state is Florida in terms of fiscal health. And the worst state seems to be right here, New Jersey, right? So this is partially due to the fact that Florida's tax system is incredibly sufficient, and their tax policy is dead set on them not running a deficit as a state. This is how things look in 2018. You can see that Kansas has actually improved. We've gone from 32nd in the nation to 17th, so we are now above average in 2018 in terms of fiscal health of the state. Florida was first. It went down to 4th in 2018, and Nebraska has become number 1, right? In last place this time, unsurprisingly, is Illinois. But yeah, these all have to do with the sufficiency of the tax system in place, as well as the tax policy of the state overall. So if our tax system is not sufficient and we are not raising enough revenue, what can we do? Well, we already talked about debt, right? One option is to borrow more to close that budget shortfall. The other is to increase tax revenues somehow. And how do we increase tax revenues? Well, if you remember in the very first class, we talked about this formula that is applicable for all taxes, right? The tax that we generate is the base multiplied by the rate. Now, what was the base? The base was the scope of the tax. Anything that could be taxed was part of the base, and the rate we said is just the rate that is applicable to that base. And it could be a graduated rate, or it could also be a flat rate, right? A sales tax is a flat rate. An excise tax is a flat rate. An income tax is a graduated rate, right? So one thing to do if we're trying to raise more tax revenue is we could exploit a new base. Now, this is going to be the most radical approach. This is going to rock the boat the most. Right? So, one example of this is, let's say, the state of Texas, we said, has no income tax, right? Suddenly, they decide to implement a state income tax, right? So, example, Texas implements an income tax. Now, as you can imagine, this is going to raise a lot of revenue, but this is the most radical approach. It's going to raise the most eyebrows as well, right? People that moved to Texas, one reason probably was because Texas had a no state income tax rate. They're going to be questioning that decision. This is going to affect voting outcomes in Texas, right? So this is a very radical approach. Exploiting a new base is not something that politicians do frequently. For this very reason, right? They're concerned about electability. Number two, this has to do with the rate, is increase the rate of an existing base. So this is less radical, but it is still radical, right? Still very noticeable. And an example of this would be, you have a sales tax that goes from 5% to 7%, right? You buy something worth $1,000. You used to pay $1,050. Now you're paying $1,070. That is still fairly noticeable, unless you're, like extremely wealthy. You're just swimming in money and you don't care at all. This would still be noticeable to you or me, who like keeps track of their finances. So this does happen more frequently than exploiting a new base, but it is also fairly rarely occurring. The third option also has to do with the base, and this is enlarge an existing base. So this is different than exploiting a new base. We're just enlarging an existing base. So this is the most frequently used, right? And an example of this is your state already has a sales tax, right? Sales tax of, you have a sales tax of 5%, and it now applies to services as well, right? Previously, it was a sales tax only on goods. So if you went to the store to buy shoes or a new MacBook or, like a new Android phone, you would pay the sales tax. Now that sales tax also applies when you go to get a massage or when you go out to eat or whatever, right? They just enlarged the already existing base. They didn't exploit a new base. It's not like implementing a sales tax when there wasn't a sales tax, right? If Delaware puts in a sales tax, that's exploiting a new base. However, if Kansas adds a few items into the sales tax that weren't previously taxed, like maybe drugs, prescription drugs, then that's less noticeable, and this is the route that most governments take when they're trying to raise additional tax money. Now, assume that Winterfell wants to increase tax revenues, and they are considering two options, right? On the table, we have implementing a new excise tax on sugary beverages and subjecting groceries to a sales tax. So on the one hand, we are doing number one, right? We are exploiting a new base. Previously, there was no excise tax on sugary beverages. We're going to implement an excise tax on sugary beverages. You know, it's going to be per ounce because it's an excise tax. You know, it depends on how many ounces of a beverage you buy. And also, consuming sugary beverages is an undesirable activity that we want people to stay away from, which is why we're implementing an excise tax. On the other hand, we have subjecting groceries to a sales tax. This is going to be number 3, right? We already have an existing base for our sales tax. We are just going to increase it a bit and add groceries into that bucket as well. Previously, groceries might have been exempt because, we considered them to be essential items. Now we want to raise revenue, so we're increasing the base by including groceries in there. Now, how would the revenue officials of Winterfell determine which options would increase tax revenues the most? Well, first of all, the first thing to consider is, right, what is Winterfell's tax policy? Like, what is our goal with our tax system? Do we want to have a tax system that discourages people from partaking in certain activities like the consumption of sugary beverages? Or do we want a tax system that's going to be neutral, right? That's one thing to consider. But the second thing is, how would the revenue official determine which options will increase the tax revenue the most? Well, the revenue officials would do something called forecasting. And there are two types of forecasting that we're going to talk about. There's static forecasting, and there is dynamic forecasting. So static forecasting assumes that nothing changes, right? We just implement this tax and people go about their lives as usual. Dynamic forecasting assumes that there will be some changes, and we're going to talk about these in the next slide, right? So let's say static scoring or static forecasting, right? Forecasting is an alternative way to say scoring in this case. So static forecasting assumes that the rate is independent of the base. So a change in the rate doesn't change the base, right? So remember, the tax is the rate times the base. We're increasing the rate. We're saying it will not have any effect on the base. So an excise tax on sugary beverages, it's a 1 cent per ounce, right? Keep in mind, this is an excise tax, so it is a per unit tax, right? It's a 1 cent per ounce, which is the unit of the sugary beverage, and annual sugary beverage consumption is 36.5 billion ounces. So what is the amount of revenue that will be raised if we're doing static scoring? You can pause it at this point if you want to do it yourself, but the answer is, it is 0.01 cent or dollar per ounce, so 1 cent per ounce times 36.5 billion ounces, meaning that this excise tax will generate $365 million of additional tax revenue. Right? Now let's look at the other example. There's going to be a sales tax on groceries. This is expanding a base, right? We already had a sales tax of 6%. Now we just want to expand it to include groceries. Annual grocery expenditures are 20 billion. So if we have a 6% tax and we have 20 billion groceries, then we have 1.2 billion that will be raised. So if we are the tax authority of Winterfell and our only policy objective is to raise the maximum revenue possible, which option would we go with? We would obviously pick the sales tax on groceries, right? Because it raises about 4 times, 3.5 times as much as the excise tax raises. We would do this if our only tax policy objective was raising the maximum amount of revenue. But what if, our tax policy objective has other considerations? What if we're thinking about future electability, right? We don't want to piss our contingency, our voters off by taxing groceries, maybe. Or we are not so much worried about electability. We just think it's, it's a bad move to tax groceries, right? So we shift away from our plan to tax groceries and we focus instead on the excise tax. So this is where tax policy comes into play, right? This was with static scoring, which we assume the rate is independent of the base, right? The rate and the base are independent of each other. So an increase in the rate does not affect the base. Dynamic scoring does not have the assumption that the rate and the base are independent of each other, right? So once again, if we throw up the tax equals rate times base formula, with static scoring we assume that the rate and the base were independent. With dynamic scoring, that assumption goes out the window. So dynamic scoring, obviously this makes it much more complex. Dynamic scoring assumes that the base and rate are correlated. So changing the rate will change the base. Now this assumption makes dynamic scoring much more accurate. It's a more accurate representation of what would actually happen if we were to implement changes in our tax system. But at the same time, it makes dynamic scoring, dynamic forecasting more complicated, right? Even with the simple examples that we'll do on the next slide, you'll see that it's a bit more complicated thought process than static scoring or static forecasting. And the reason that dynamic scoring makes this assumption is because of behavioral responses, right? The incremental revenue generated by a rate change depends on whether or how individuals modify their behavior, right? So just thinking back to the previous example, if we implement an excise tax on sugary beverages, it might be the case that people don't drink as many beverages, as many ounces of that beverage as before. So just simply multiplying this rate by this base might not lead to such an accurate forecasting of, the potential revenue that we will raise. Similarly, if we put in a sales tax on groceries, people might not buy as many groceries as they did previously, right? Instead of buying 2 dozen eggs, you might buy a dozen eggs. Instead of buying a gallon of milk, you might buy half a gallon, so on and so forth. So it is a more accurate representation of what happens because it takes behavioral changes into account. However, it makes things a bit more complicated. And there are 2 types of effects that lead to these behavioral responses. One, and these are important, one is the income effect and the other is the substitution effect. So the income effect says that when taxes increase, taxpayers will work harder to maintain the same after-tax cash flow. So an example of the income effect is you're on a treadmill, the speed increases, you're running faster just to stay in the same place, right? Here, taxes increase, so as a taxpayer, I start working longer, I start working harder, I start working multiple jobs in order to make the same amount of income after the tax, right? With the substitution effect, when taxes increase, taxpayers substitute leisure for labor. Taxpayers engage in less income producing activities and more non-income producing activities because after-tax cost of labor has increased. Right? So on the one hand, we have the income effect, which says that as taxes go up, we'll work harder. Because if previously we were paying, you were making 100 and you were paying 10 as a tax, you were making 90 after tax, right? If taxes go up to 15, now you're making 85 after tax. So you might work harder and make 105 before tax, so when you pay 15 in tax, you still make the 90. Right? You're running faster, you're working harder just to stay in the same place. The other effect, the substitution effect, means that you will substitute, right? As the name implies, you will substitute activities that generate money for activities that generate pleasure for you, right? Because you think it's too costly, it's not as cost efficient anymore for me to work those extra hours because I'm going to be taxed on the amount of work that I do. Now, the interesting thing, which I think is very interesting about the income effect and the substitution effect, is these affect different types of taxpayers very, very differently. Now, take a minute to think about that. Who do you think is affected more by the income effect? You can pause the video, think about it, and unpause it. But low-income taxpayers are affected more by the income effect. If taxes go up, people that are working multiple jobs, that are barely making ends meet, that are working the 9 to 10s, right, 9 a.m. to 10 p.m. jobs, whatever, those are the people that are subject to the income effect generally. Those are the people that have to run harder in order to stay in place. So then who is affected by the substitution effect? Well, those taxpayers that are in the high-paying jobs are those that are affected by the substitution effect, right? If you're making a lot of money, if you're a doctor, if you're a CEO, a CFO somewhere, hopefully you will all be in that bracket. Hopefully you'll all be influenced by the substitution effect more so than the income effect. But if you are a high earner, you are more so influenced by the substitution effect, right? If taxes go up, you have the luxury of saying, you know what, F it. I just don't want to work as much as I used to because more of the money that I make is going to go, to the government's pocket. So then you end up, like the high earner ends up devoting less time to work, more time to leisure. So it's interesting how these two behavioral responses come into play when we talk about dynamic scoring, right? They have the same end result. The end result being that a change in the rate influences the base, but they have totally different outcomes and they have totally different paths. Now, this concept of a Laffer curve is very important when we talk about dynamic scoring. And the Laffer curve was created by an economist. His last name is Laffer. I forgot his first name, but an American economist. And this curve is essentially showing you how dynamic scoring works. So if you have a 0% tax rate, obviously you have $0 of tax revenue generated, right? And if you have a 100% tax rate, people are either going to not engage in that tax-making activity, or because you're extracting all of their money away, they're either not going to work or they're going to do everything in their power to avoid paying taxes. So at a 100% tax rate, you're also generating zero tax revenue, right? So this Laffer curve shows that there's a sweet spot of taxation. It doesn't make sense to just crank up the tax rate, right? Because at this point, this is the growth maximizing point. So at this point, you still have positive tax revenue generation as you increase the tax rate, but it's at a slower rate. And at this point, you actually have your revenue maximizing point. Any tax rate beyond this rate is now producing less revenue for you because it's too costly for people, right? They're either really opting out by choosing the substitution effect. They decide to substitute any sort of income generating, tax generating activity for leisurely activities, or they just are still subject to the income effect, but they can't work anymore, they can't work any harder, so they start avoiding taxes, right? So there is a point at which taxing more makes no sense. And once again, this is all part of a government's tax policy, right? Like, what is the intended consequence of your taxation? So let's look at some of these scenarios that we talked about, whether it's the excise tax on the consumption of sugary beverages or whether it's the sales tax on groceries, and see what sort of, intended consequences they would have if we're doing dynamic forecasting, dynamic scoring. So we have an excise tax on sugary beverages. Remember, it was a cent per ounce. And originally, we had 36.5 billion ounces of sugary beverages being consumed. But after we implemented the tax, it dropped down from 36.5 billion ounces to 25 billion ounces. So instead of generating, 365 million, which is what we had gotten with static forecasting, right? When we assume that the tax rate and the base are independent, we are now generating 250 million, right? With dynamic forecasting. So, it's the rate times the base. The tax is the rate times the base. The rate, we said, was 0.01 cent per dollar per ounce. And the base drops from 36 billion to 25 billion. So it's, that 1 cent per ounce times 25 billion. That generates $250 million of potential increases in revenue generation through dynamic forecasting. Now, sales tax on groceries, right? The key here is groceries are more of a necessity. So yes, we could decrease our purchases to an extent, but we still need to eat. So we're not going to see as sharp of a decrease, when we implement the sales tax on groceries. We still have a 6% sales tax, right? And that drops from 20 billion to 19.5 billion dollars worth of groceries purchased. So 1.17 billion is what we're raising with dynamic forecasting, as opposed to the 1.2 billion, right, that we had forecasted with static forecasting. But once again, what is our tax policy as a governing body, right? Do we shy away from taxing groceries because they're a necessity, or are we only interested in raising revenues as much as we can for it's possible? So for dynamic scoring, try and consider more than the direct effect. Think about the potential effect on manufacturers, suppliers, employees, etc. Right? This is why dynamic forecasting is a much more complicated concept than static forecasting. So we already talked about sufficiency of the tax, right? Up to this point, we've talked about how our federal tax system wasn't sufficient. The state of Kansas has a fairly sufficient tax system. We talked about what sufficiency means. And we talked about how we could make up for an insufficient tax system by either borrowing, right, debt, or manipulating the tax, either the base or the rate, right? So now we're going to talk about convenience. And a good tax should be both convenient to administer and convenient to pay. So a good tax should be one, convenient to administer, right? And this is from the government's point of view, right? It should be easy to collect, and it should be, like effortless or minimal effort. And it should be cost efficient. Right? So a convenient tax should be easy to administer for the government. It should be easy to collect, should be, minimal effort and cost efficient. If you remember back to the very first video, we talked about real property taxes and personal property taxes, right? And we talked about how these taxes needed to be paid on the market value that is assessed on the property. For real property, that's someone coming by and giving a value to your house or your cornfield or your oil well, right? Someone comes by and gives a value and you pay a tax on that value. We said that personal property we don't really pay a tax on because it's self-reported. It would be very, very inconvenient for a government official to come out, walk around your house, and take the value of all your personal property to assess a value so that you pay tax on that value. It would be super, super inconvenient. Not only would it be, not minimal effort, but it would also not be cost efficient, right? How much are you going to pay that assessor to come by, walk through your house, give everything a value? How much is this going to cost when, we're talking about a town of a couple million people, a couple 100,000 people, right? If it costs $1 to collect $1, then that is a really bad tax, right? It should cost you pennies on the dollar for it to be worth your while as a government to collect that tax. So, a personal property tax is not going to be easy to collect, it is not going to be effortless, and it is not going to be cost efficient, right? If it costs $1 to collect $1, it's a no-go. The second aspect of convenience is that a good tax should be convenient to comply with, right? And this is from the taxpayer's point of view, right? It should be easy to pay. It should be easy to compute. It shouldn't take a lot of time, right? We talked about a lot of taxes that are not convenient from a taxpayer's perspective, right? They might be convenient from a government's perspective, but not convenient for the taxpayer, like the use tax, right? It's convenient from the government's perspective because the government doesn't have to come out and do anything, but it's not convenient from the taxpayer's perspective, right? You have to record what you bought out of state, at what price, for which sales tax. You have to calculate the difference between that state's sales tax, your state's sales tax, get that difference, and then you have to remit that difference to the government. So this use tax is a god-awful tax, right? It's not convenient. Not convenient for the taxpayer. A real property tax is convenient for the taxpayer and convenient for the government. A personal property tax is not convenient for the taxpayer. It's not convenient for the government, right? So a sales tax is a great example of a convenient tax. It is convenient to administer, right? It is convenient to administer because the retailer is remitting the tax on behalf of the customer. So the government doesn't have to process returns from each customer, right? You go to Hy-Vee, I go to Hy-Vee, everybody on my block goes to Hy-Vee, but not all of us submit a return on the items that we brought from Hy-Vee to the government. Hy-Vee does that on our behalf, and it does it for everybody in Lawrence, for all transactions for that year, right? It's very convenient to administer for the government. And it's also very convenient to comply with for the taxpayer, right? When you go to Hy-Vee, you don't think about the sales tax. When you go to Best Buy, you don't think about the sales tax, right? When you go to, I don't know, Foot Locker, you don't think about the sales tax. You just pay it, it's done, right? You don't have to go home, calculate, oh my God, what was it? What's the sales tax rate in the county? Okay, we're in the city of Lawrence. What's the Lawrence tax rate? What is the state of Kansas tax? You don't have to think about any of that. It's already programmed into the cash register, point of checkout, it's done, it's out of your mind, right? It is super convenient to administer, it's super convenient to comply with. So a sales tax is a great example of a convenient tax. Now here's a question for you to think about. And pause this, think about it before you go on, right? Is the federal income tax convenient? We already talked about how it's not sufficient, right? It's not raising enough revenue to meet the expenses of the federal government. Well, is it convenient? For the government, extremely convenient, right? It is super easy for the government to administer. The IRS spends only 35 cents per $100 of revenue collected. All right, so if you have a tax return where you owe the government $1,000, the IRS only pays $3.50 on average to process that return. It's super easy, right? I mean, it's an automated thing. Unless you have extremely complicated taxes, you just go in there, enter everything, and it's automatically processed. And you know if you have a refund due or if you owe money. It is extremely convenient to administer. Now the question is it convenient to comply with? Right? That's the question. And the answer is it's not really that convenient for the taxpayer. I mean, first of all, if you've seen the tax code, it's, you know, it's about the size of a baby. It's huge, right? And it's very costly for individuals to file their taxes. I mean, generally at this stage in your life, because you're an undergraduate student, you know, it's fairly easy for you. But as you grow older and you have more complex investments and different sources of income and, you know, so on and so forth. You know, I had a colleague who was living in Connecticut, but she had income from Texas, and her husband was also working in Canada, so they had, you know, like, you need to talk to a tax attorney. And this was someone who was an accountant, right? They needed to talk to someone who had tax expertise to kind of figure out what they needed to do. So not only is there very long and complex law system in place, right? The Internal Revenue Code, which if you remember from last class is essentially the book of tax laws, is 70,000 pages long, but it's very costly. Taxpayers dedicate 3.24 billion hours and $400 billion to compliance. So it's very easy to administer. it is not very easy and convenient to comply with. And that is essentially the lecture for today. Thank you very much for being patient as we work through these issues.